All right, let's talk about something really interesting from this last earnings season. A company called American Integrity Insurance comes out with what looks like a perfect blowout quarter. I mean, by any measure, they knocked it out of the park. But the market's reaction? Not what you'd expect. And that disconnect, that paradox, is exactly what we're going to break down today.
So here's the deal in a nutshell. On one hand, you have the results. American Integrity, let's call them AI, didn't just beat Wall Street's expectations, they completely crushed them. Earnings per share were up 15% over what analysts were looking for, and revenue beat by 11%. Fantastic, right? Well, on the other hand, you have the reaction. The stock dropped 6.5% on the day. So a huge beat followed by a pretty sharp sell-off. That's the puzzle we're here to solve.
And that really brings us to the big question, doesn't it? What gives? What did the market see that the glowing headlines completely missed? What was hiding in the details of that earnings call that made investors hit the sell button even when the numbers looked so good on the surface?
So here's our game plan. First, we're going to dig into just how stellar that quarterly beat really was. Then, we'll listen to the growth story management was telling. After that, we'll decode the market's weirdly negative reaction, put it all into the bigger picture of what's happening in Florida's insurance market, and then we'll wrap up with our own prediction for the next call. Okay, let's kick things off with the results themselves, because honestly, they were impressive. This wasn't some tiny beat, this was a straight-up blowout that showed real strength pretty much everywhere you looked. I mean, just look at the scale of this outperformance. Let's start with earnings per share. AOI delivered 71 cents of profit. That is a massive beat. Revenue also sailed past expectations by over 11%. And get this, year-over-year growth was over 33%. On paper, this company is absolutely firing on all cylinders. And, this wasn't some kind of accounting magic. The growth was real. You could touch it. Their policies in force, which is really just their customer base, shot up by almost 49% from last year. They are adding customers like crazy in their main market and doing it successfully. And here's the really crucial part. All that growth was super profitable. You look at their combined ratio, which is a key metric in insurance, where anything under 100% means you're making money on your policies. It fell to an amazing 78.9%. Now compare that to over 94% just 1 year ago. That points to a huge improvement in how healthy their actual insurance business is. So with numbers like that, you'd totally expect management to be feeling pretty confident on the earnings call. And yeah, they definitely were. They laid out this really clear, compelling story for why this is just the beginning. And this quote from the CEO, Bob Ritchie, really just nails the whole theme of the call. The message was simple. Our discipline in the past, especially in how we write our insurance policies, has put us in the perfect spot to grab all the opportunities in a really favorable Florida market right now. And they laid out exactly how they're going to do it, a three-pronged plan. First, they're re-entering the huge Tri-County market down in South Florida. Second, they're launching a brand new commercial product. And third, they're expanding outside of Florida into neighboring states. It's a really clear roadmap for where the future growth is going to come from. Okay, so we've got blowout numbers, we've got a confident growth story, and that brings us right back to our puzzle. Why the sell-off? Let's put on our detective hats for a second and figure out what the market was really thinking. The first clue is right here. Just look at the run-up before the earnings report even came out. The stock rallied over 11% in the week leading up to the call. So that kind of set the stage for a classic buy the rumor, sell the news situation, where a lot of the good news was already baked into the price. But it was definitely more than just some simple profit-taking. There were three other things going on. First, the company announced something called a secondary offering, which basically means a big chunk of existing shares was about to be sold on the market, creating selling pressure. Second, and this is a big one, was the guidance for the future. Management hinted that their gross loss ratio might tick up by about 1 percentage point. Now that's small, but in the insurance world, any sign of profitability getting even a little bit worse can make investors pretty nervous. So to really get the full picture on AI, we need to zoom out a bit. The market might have been focused on those short-term headaches, but the company is actually operating in an incredibly supportive environment right now. You see, the whole setup for Florida insurers right now is the best it's been in years. There's been recent legal reform that's cutting down on lawsuits. The state has had a quiet hurricane season, thank goodness. And reinsurance, which is kind of like insurance for insurance companies, is actually getting cheaper. All these things are powerful tailwinds, and AII is sitting in a great spot to catch that wind.
So let's put all these pieces together. We have the stellar results, we have the short-term market freakout, and we have this really strong macro backdrop. What's our call from here? What should we be looking for in the next earnings report?
Well, fundamentally, the story here is still very, very strong. We fully expect AIGA to keep growing its policy count and to keep posting solid profits. The key number to watch is going to be that combined ratio. Just like management guided, we think it'll probably normalize a little bit from these amazing levels, but it should still stay very healthy. And as for the stock price, well, that secondary offering is probably going to keep a lid on things in the short term. But once the market finishes absorbing that new supply of shares, we believe the focus is going to snap right back to AOI's incredible performance, letting those strong fundamentals drive the stock higher over time. And so that brings us to our final rating, outperform. To us, the sell-off on earnings day looks like a short-term reaction to some share supply and a tiny tweak in guidance, while the underlying business and the favorable industry trends all point to continued success. And as always, just a reminder that this analysis is for informational purposes only. It is not financial advice.